Hello and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, are you a real estate investor and concerned about liquidity? Well, if you are, stay tuned. Our topic today is the three questions real estate investors should ask about creating liquidity. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. On this week's episode of the podcast, we're tackling an issue that many real estate investors underestimate, and that is creating significant liquidity. Joining us again from beautiful Miami, Florida, to review the three questions real estate investors should ask about creating liquidity is my friend Gretta Zutz. Gretta is a financial specialist at the Center of Wealth Preservation. Gretta is a seasoned financial professional serving a diverse clientele from artists, which she has a little bit of a background in, by the way, from artists to CEOs. And I can tell you, I know her personally, she is passionate about educating clients on building legacies, providing solutions for businesses and individuals, and focusing on longevity and sustainability. And she is also, we should probably even talk about this a little bit, because she's a member of WIF, or Women in Insurance and Financial Services. Gretta, my friend, great to see you. How you doing?
I'm great. It's beautiful here in Miami. I mean, it's warm, but that's what you choose, right? I can't complain being from the Midwest originally. So thank you for having me, Wayne.
So before we go any further, I need to know more about WIF, Women in Insurance and Financial Services. So how did you become involved in that organization, and how much havoc are you creating within that organization? I think is a better question.
It's been an awesome organization because I still am hearing that less women are coming into the industry in terms of not financial services broadly in banking and investments, but on the insurance side, we still have less women. Now, we do have a lot of women in health insurance or property casualty insurance, but in my area of specialty with long-term care insurance, it's less women that we find. So it's a wonderful organization. It's a national organization, and we just come together, support each other, share case studies, and share different marketing techniques, especially around long-term care insurance.
It's interesting you brought that up about the sharing among professionals. There's this illusion out there that financial professionals are sworn enemies of each other, fighting for each other's clients. I can tell you right now, my biggest referral partners are other financial advisors, believe it or not. I did an analysis. I know I could update it, but the last time I did the analysis, I think over a third of my referrals came from other financial advisors, both here and in Canada. So yeah, we help each other. We support each other. We're not like Hatfields and McCoys.
I'm sure there are some, but I don't know how far they'll go because
Right.
it's such a sharing world of how can you possibly know everything about everything in the
Right.
world of financial services? And to be, your specialty, though many specialties that you have, but with the cross border, when I'm speaking to someone, being from the Midwest, I do encounter a lot of people from Canada, and just knowing that I have access to you is so wonderful for those clients. And if I didn't have that, I'd be a one-trick pony.
Well, you're certainly not that. And speaking of not being a one-trick pony, I'm going to do a shameless plug here for the podcast website. We have a broad range of episodes on wealth management, on investing, on insurance, on risk management, on immigration, estate planning, tax planning, etc. If you go to our website, www.onecapital.com/three questions, the number three, the word questions, .php, you're going to get a full menu of episodes as well. We're on our way past 120 episodes already, and look forward to doing many, many more. And love the fact that you're able to make some time for us today, Greta. Uh, Before we get to the questions, though, I want to first talk about the issue of liquidity from a real estate investor perspective. Now, this is something that you and I have talked about, we'll say offline, and I'd really like you to share your thoughts on just overall the lack of liquidity from the standpoint, because it's really, I think, a major hurdle for real estate investors here in the US because real estate hard things, assets, they're not liquid. You can't eat a house, right? In theory, right? They often take months to sell. They're potentially forcing owners to accept lower prices during market downturns or personal financial emergencies. Illiquidity ties up significant capital that could be otherwise deployed for more flexible investments or used to seize prime timely opportunities. There's a missed growth potential, obviously, and also there's increased vulnerability during economic shifts. And I would furthermore say without adequate liquidity, investors may struggle with ongoing expenses like maintenance, taxes, mortgages during periods of low rental income. This can cause additional cash flow issues. And there's also, you want to get dramatic about it, risking foreclosures or forced sales. You're just overall, what's your take on all of this?
Well, I think in the US, we're sort of groomed, if you will. When are you going to buy your first home? It's such
Yeah.
a rite of passage. And then
Mm-hmm.
when are you going to buy the vacation home? When are you going to add the investment property? That it's sort of like a thing we like to brag about in this wonderful way. And a lot of families have built generational wealth using real estate. We're not saying
100%.
that's not available. It's absolutely wonderful in that sense. But to your point, you brought up, we call them the T's, termites, trees, tenants, all those things. And I'm thinking, living in New York for 22 years, there was a property offered to my friend and I for 30 grand, a brownstone in Fort Greene, Brooklyn. This is going back 2 decades. We couldn't come up with the money, but that property recently sold for 7 million. So what were we thinking that we couldn't come up with 30 grand in our 20s? Oh, what was wrong with us? But the idea that you're going to build your biggest wealth in, like you said, real estate, clients, when you ask them outright, what's your biggest asset? Home, real estate portfolio. It's without even, it's like a initial response.
And it's usually wrong. I'm going to debate that one right now. Okay, this is why I like you and I will go off the rails here. I'm going to go off the rails. Back in 2003, or as my son would say, back when dinosaurs roamed the earth. I did one year, I think it was 2003. I did a survey of everybody I met that year. It was, small things amuse small minds. I asked everybody I met that year, every prospective client, what their most valuable financial asset was. You know what? Every one of them said
Their
their
house.
house. You know how many were right? One. One. Everyone else, their most valuable financial asset was, and the answer is their
Your ability
ability to
to,
make money.
it's
Interesting.
it's so over, it's that rite of passage, right? And then your parents did it. So there's pressure to like get into real estate. And with someone who spent, as I said, 2 decades in New York, I mean, I don't even want to tell you what I've spent on rent over the years before I did finally purchase something. But that idea, you said it before in the illiquidity. So a real estate portfolio, wonderful, but when has it last been analyzed? What's the plan for that real estate portfolio? Are you passing it on? Have you done the estate work? Did family members even want that? We hear often, you probably hear this too, that some of the biggest fights in a family happen when you think you're going to get grandma's, mom's property, and then there's no plan for offloading that property. And then we have a lot of tension between the family members. So we're not saying real estate in terms of wealth building or generational wealth building is anything but wonderful. But without the study around it of what is the plan for that real estate, maybe it's that summer, vacation home or that winter cabin that you're all going to go to and experience. And it's not about, the cost that you will sell it for eventually. That's wonderful. Create those memories. But to be so illiquid that you haven't protected and put a moat around your castle, that's where things go really wrong. And I can't wait to tell you a story as we get into the 3 questions about that.
Well, no one's going to argue that real estate has long been a cornerstone of wealth building here in the US. And I think Southern California is the obvious place. But again, the lack of major liquidity can be a major challenge. And, they may own valuable properties, your clients may, But converting the wealth into flexible, accessible capital can be complicated, and this can limit opportunities, create estate planning headaches, and even cause family stress when family needs, out of nowhere, arise. So that's what we're going to focus on today. And let's get right to our three questions. Question number one. I know you're going to love this one. My life insurance agent says, sell your real estate and buy life insurance. Is that a good idea?
Well, Wayne, life insurance is tax-free. So as long as you've got, the plan to die right away, it's a wonderful idea. We can show the internal rate of return as being blowing through any kind of real estate sale. So let's put it in context. If that insurance person is only about insurance and not doing holistic planning and not able to assess and analyze the
Be a little
real
bit more transaction
portfolio,
based, perhaps.
yeah, the Hungry Hippo game. I'm dating myself. I'm telling my age by saying my favorite game, the Hungry Hippo. So it's not all in one, right? It's that another game. I love Trivia Pursuit. Let's get a slice of each pie. Let's get the
Canadian
accurate.
inventor, by the way.
Yes, I
To throw
knew.
that in there. Sorry for
No,
cutting you off.
no, I knew you would, I knew you'd catch me on that one.
Yeah, there you go.
Such a good point. It's never wrong, I believe, for the consumer to ask that person who had that statement of, sell this property, take the proceeds, buy life insurance, or put it in some life insurance type chassis. Why? What is the transactional commission on this? What is this doing
Yeah.
for my overall portfolio? We ask in so many other places in our world, we're very candid with what the person on the other side who's servicing us is maybe have their skin in the game. But it's
Hmm.
okay also to ask the professional helping you with this how they're compensated. That's very normal. And I want clients to feel very comfortable in doing that. And then really being self-serving. What purpose does this insurance serve in my overall plan? Maybe offloading that one piece of real estate because the kids don't want it and you don't want interfamily fighting that we talked about earlier, and you don't not really going there. You're not seeing an uptick in that market, floods, tornadoes, whatever it might be these days. Anything can happen anywhere. Maybe you want to hold on to it for sentimental reasons and you want to pass it on to future generations. But to have it ongoing analyzed, not just by a real estate professional, but by your wealth advisor, by your planner. And then, yes, maybe the insurance comes in as part of the plan, but certainly not triggered by this over that. We're talking apples and oranges.
You know, I got a question for you, but I want to comment on this point you made earlier about the motivation of the insurance professional. I tell my clients this more than once that whenever, like yourself, I'm life insurance, health insurance licensed, and I'll tell clients, this policy that you're buying here today is not going to change your life for the better, but it will yours. And I think that's kind of the baseline here. If we ask if we discover that like in this example, that maybe that sale could change the life of the insurance broker more so than the client, that's a bit of a problem, right? So the idea of these plans is they're not supposed to be life changing for us. They're supposed to be life changing, favorably life changing, for the client. But just to follow up, again, I know this is a space that you're working regularly, so I'm going to throw it at you. For investors who have built significant wealth in real estate, what do you think are the trade-offs for exchanging a tangible property for a financial product like insurance? I mean, there is a give and take here.
As we said, the trade-off can be very realized and analyzed and shown. So it could be a tax trade-off in that, well, if I'm not, purchasing my first home and selling that, and I'm going to have gains on the sale of this property, I'm okay with those gains and realizing what I might have in a taxation from the sale of that real estate. And then walking over to the world of long-term care insurance, life insurance, or hybrid products, which is in another earlier episode of yours, that maybe the positioning of those funds into something else secured, guaranteed, slow growth. Who wins the race? I think it's the hare. No, the tortoise. That's right. So it's
Mhm.
about that longevity play. That could be something that would offset future estate taxes, perhaps more than the real estate could have. You could use it for an income stream in the future, long-term care needs, estate planning for future generations, sort of like your gifting tool in your plan. So there can be a wonderful, beautiful trade-off in technical terms, if you will. But again, it's all about the analytics. And I want to share one quick story with you, if I might.
Hmm.
I'm smelling this beautiful gum here.
Oh, wow.
Wrigley.
Spearmint. There's a blast from the past.
Yeah.
Little props. This is the first. Who
Prop.
else, Greta? I know. Why am I not surprised? Okay, carry
You've,
on.
you've heard first generation builds the wealth, second generation enjoys the wealth, third generation squanders the wealth.
Thank you for finishing. I was just going to say that. I was going to say destroys, but
There
carry
you
on.
go. So, why am I showing this? Well, the story of Wrigley is very interesting because we had the family holding that property, huge real estate holdings. And when William Wrigley Jr.
This isn't
passed,
going to be good down to the Cubs. We're not going to end up talking about the Chicago Cubs here.
we are, for us, for just from a numbers perspective,
Okay.
the estate taxes being so high that third generation, William Wrigley the third, say that three times fast, was not prepared for the estate taxes of the family's real estate holdings. So Wrigley Field was sold, are you ready? For 20 million. Now this was 1981, that was still a big sale, but now that real
There's a
estate
B. There's a
and
B
the
in the
Cubs,
number.
you got a B. You got almost 5B, 5 billion. So the fact that the planning wasn't done, and what did the generation not have? Any life insurance. So the 50 million in estate taxes that were due in the 70s, yes, we were a higher estate tax bracket then, but there was no way for the family to cover those estate taxes, and therefore Wrigley Field is no longer in the family. Still enjoyable as a gum.
My God. Well, I've said this so many times, and I probably at risk of being saying again, Wayne, again, Wayne. But again, those who fail to plan to fail. And that would be Exhibit A with props. Why am I not surprised? Uh, well, Greta, let's carry on to question number two. I currently own 5 real estate properties, and I have more cash flow than I need for income. What do I do with the additional liquidity? Greta, this is right down your alley.
It's so wonderful because if I go to my parents' generation, so now we're talking about them coming up in the 80s. What was popular in the 80s? I think of really bad style
Big
and I think
hair.
of big, feathering, layering of
Motley,
socks.
Motley Crew. Sorry, I had to think.
And I also think of like diet trends, meaning what we thought was right in the 80s, the fat-free, the Olestra. Oh, please, if you've tried the Olestra chips, if anyone remembers that debacle. The idea that in avocado, maybe not in California, but in other parts of the world, we did not eat avocado with that regularity in the 80s. So this idea, what was really present and is still present for a lot of people today is how we managed portfolios in terms of real estate and other things, your savings, your emergency fund, your long-term care, your protection needs. I'll go as far as to say in the 80s, I don't know that advisors were even talking about insurance. So things like life insurance or long-term care insurance, well, there certainly weren't the hybrid policies that we talked about in another episode. And definitely life insurance kind of fell out of favor. So it wasn't cool, it wasn't fun to talk about. We just sort of thought in the future, well, we'll live off this fat-free diet, and then we'll also just, offload some of the real estate. No big deal. No worry about taxes. CDs were earning 16%. It was a beautiful day. So now here we are, decades later, the shift has changed. Everything's more accessible by phone. We can get ourselves into debt without even getting a paycheck. So the idea now,
That's for sure.
yeah, if I explain to my grandmother like you're going to pay in the future just by waving a hand, she wrote checks for everything. I think,
To think I can look at a device and turn on my computer. I can open up a website by looking at my telephone, literally open up a website by yeah.
just so fast. And I don't know that we're really analyzing that daily. And families with a real concentration in real estate today, again, can still build wealth. So in your example, someone holding 5 properties, creating income, that's wonderful. Are they protected from a lawsuit perspective? If someone finds out that they are worth that amount of money and doesn't have the right amount of protection
Oh
around the
boy.
castle,
There's
what
stories about
happens?
that I have to tell you about. Next time I'm in Miami, I got to tell you the story about one of those. I have one.
It's
Not for
so,
today, but I'm going
yeah,
to remind me, okay?
I
Seriously.
will. I'm making a
Okay.
note.
Note that one.
But it's very easy to say, yeah, go put some insurance in place. But what we have to also remember about insurance is there's a barrier to entry. So you have to show your human health score. You have to show
Right.
your driving record. You
There's
have
an
to show
underwriting process.
that you're insurable. So
Hmm.
that's why it's not necessarily that we're jumping and saying that this person with extra income should buy insurance. That's not what we're saying. But what we're saying is they really do deserve, if rental income's coming in from 5 properties, they really do deserve a full, holistic, analytical, number-driven plan about what can happen. And let's remember also in retirement, we could be living 40 years in retirement.
I had a meeting yesterday. Get this, Greta. I had a meeting yesterday with a lady from Texas. Her entire family, both sides of the father, both sides, all lived beyond 90s, some early hundreds. You know, I always tell people the biggest financial risk a lot of people are going to encounter is longevity risk. Inflation, number two, getting sick, not dying, that's a biggie, but longevity risk. You know, not to go on a tangent here, but longevity risk is a big one. Um, I want to do you mind if I just make one comment before we move on to the next question?
Absolutely.
So beyond reinvesting in more properties because he's got all this extra cash flow and in probably purchasing some much needed insurance, I think there are other diversification options to take into consideration. Obviously, the obvious ones, stocks, bonds, ETFs, that can be utilized to balance that risk. You don't want to be overweighted entirely in one asset class. Now, the key to all these strategies, in my view, and you kind of mentioned it earlier, is to first put together, design a well thought out wealth management strategy. The shotgun approach of what seems like a good idea today, let's do that, uh, really doesn't work, and it can lead to some really significant unintended consequences. And I know you probably want to chime in on that, but that's just this whole idea. I come into extra money, let's do it. Like, great idea, let's do this. A shiny toy over here. Let's just do that. Failing to really analyze, to me, that's where you get into, like I said, unintended consequences.
I love that you said that because I think again, it's such we are so open about our real estate holdings and we love to talk about that just as a culture in the US. But it's that sentence, it's that thing that you and I talk to clients about, which is are you asset rich and cash poor? Have you gotten every part of the Trivia Pursuit? I always miss the sports one. Always. Don't give me the sports one. I'm never going to get it. But that idea that a well-rounded and diversification in the true sense is not just different stocks or different bonds. It's by having everything addressed, especially with someone like you who's really looking out for that for clients. So again, what we said before, have that conversation. You, as a consumer, working with your current advisor, if it's not Wayne yet, I don't know what you're thinking, but if you're working with someone else, are you not having these conversations? Are you asset rich, cash poor? What happens in a lawsuit? What happens in a divorce? What happens in a creditor situation? Do you have to then be asset poor?
Okay, Greta Zutz joins us today from beautiful Miami, Florida. And we're going to get on to question number 3 here. We're talking about in real estate investors and the lack of liquidity. So, question number 3. I recently received an inheritance from my mother's estate. How do I divide the proceeds between insurance, investments, and real estate? Greta, you get the first shot at this.
You'd think I'd have an answer of 20, 30, 40, 50. That would be easy to answer. But the real answer is, why not have that inheritance be the cherry on top of the financial sundae? Why
Hmm.
not have everything taken care of already? So when and if, because sometimes in generations we're told an inheritance is coming, this person in your example already received it. But are there taxes due? Do we know anything? Is it just coming straight to you? Is someone else going to come after it? Is it tangible? Is it deposited? I would much rather a client have everything taken care of in their financial world. And then when and if that inheritance comes in, it's not actually about splitting it up in a certain way, though we could come up with a number if really asked that. But it's more about putting that icing on top and saying, well, now let's do something beyond your wildest dreams. Do you want to retire 5 years early? Do you want to gift it? And that's really what we want clients to start realizing is though there is the great wealth transfer, let's be prepared in our own world, eradicating debt, leaving behind generational happiness, not generational sadness, fighting within the family when that inheritance.
Havoc, chaos, acrimony, all of those wonderful things.
Yep. The easy way would be for me to say, do 20% here, 30% here. But every client is so different that the answer,
Everybody has their own financial DNA.
there you
That
go.
you brought that up. And I would add to that factors like age, cash flow needs, estate planning, risk tolerance, time horizon, all will influence the allocation percentage across all of these areas. So there's a whole bunch of different factors, and the financial DNA, and there's no right answer for every. There really isn't. You have to do a really deep dive discovery for each case, and each one of them will have their own end up with the right strategy, and it won't be the same because everybody has their own sensitivities of that other people don't. Some people are more risk tolerance. Other people be more tax tolerant. Other people have more legacy planning intentions. Other people, I don't have any kids, I have no descendants. Maybe they're going to be more charitably inclined. Everybody has their own sort of situation. And what we do, I say we collectively, what we do as planners is do all that sort of architecture first and then say, here's what we really need to do based on everything you told us about your situation.
That's it.
Um, you know, I want to talk a little bit about what you're seeing here in terms of emerging trends in real estate from the concept of collectively, from the standpoint of real estate and insurance planning. And how do you see liquidity impacting the way investors proceed over the next few years? And you look at insurance, like, the fact you have, I think about your background in New York really kind of gives you a leg up on a lot of people because there's a scarcity there. They're not building any more, too much more real estate in Manhattan, for example. So how do you see those two variables, the real estate part, the insurance part? How do you see that evolving over the next little while?
Well, I'll take it back to my story earlier about the brownstone in Fort Greene that I didn't buy for 30 grand that sold for 7 million. I did actually talk to those people and worked with them on the insurance side. Now, what was interesting is though they sold for 7 million, where did they live after that? It was very hard to find a place at that point in time. This was about 2019, a place that was as desirable. So that 7 million didn't go as far as you think in New York. So going back to what you said and the question, getting down to your goals and really understanding those different phases of our world and knowing that longevity more than ever is really present in our world. In with certain trends that we're seeing is potentially getting out of a home before you need to, not leaving it behind, taking those proceeds, looking into something like a CCC, which is continuing care place, for caregiving, gifting, different strategies with your estate attorney. We're seeing a very shift in trends of what it means to have irrevocable trusts and ILETs. These is a lot of jargon that estate attorneys would use. But what we're seeing is more of an intersection and trend of having a team, having your estate attorney with your CPA with your financial planner and your insurance person all come together and really plan for you, almost like hiring a team. If you were, it's a celebrity and someone's there changing the outfit and doing the hair and doing the makeup and getting you back out on stage so that you can still continue to live life and preserve family legacy. Don't be a Wrigley. Don't squander it away. Don't be subject to estate taxes, and hold on to that real estate if analyzed and if it's what you want to do, not just because you think it's the trend.
Okay, Greta, I know we pretty much come to the end of the episode here, but I got to ask one last question. That is this. The folks have been listening today. Today, you're obviously an expert in your field. What is and how can people reach you? If somebody says, listen, really smart lady, I'd like to learn more, how do they contact you? How can they find you?
You can find me on LinkedIn. I'm the only Gretta Zutz there. Two Z's at the Z-U-T-Z, two T's in Gretta.
Oh, by the way, we do have all of your information, but I should have
Perfect.
mentioned this. I'm gonna make one more point. So for those who are watching, they have all of your contact information right under your picture on the screen. So there are also people listening on Apple and Spotify, which I know because I know you follow the podcast. So for the folks that are listening, what's the best way for them to reach you?
I always tell people LinkedIn is very active because you can get right to my calendar link. You can also reach me through my email, which is GRETTAZUTZ @financialguide.com.
I like the way you did your Z's. See, in Canada, we say Z. So I always get confused now. Is it Z or Z, or which is it? A potato, right? Greta, thanks a lot. It's great seeing you again. Really enjoy your company. And we do have to get together for when I'm going to be in Florida. I got to tell you the story. I really have to tell you the story about the insurance and the inheritance, but we'll get to that in person. All right. Gretta Zutz joined us from Miami, Florida, and she is a financial specialist at the Center of Wealth Preservation. Gretta, thank you very much. I look forward to bringing you the 3 Questions podcast, and I hope you do find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.